All right, this is going to be a short video on drawdowns. This is a jargon term from Wall Street. What is a drawdown? A drawdown is just a decline from a prior high watermark of a portfolio, of a stock, or of the stock market. And the other day I was listening to an excellent 1-hour talk from a guy named Robert Frey, who did a discussion of the history of drawdowns in the United States stock market. Very, very interesting because he found some sort of counterintuitive, unexpected data, which is that most of the time the stock market is in some form of drawdown. I think he said something like 75% of the time the market is in drawdown. And if you think about this a little bit, it actually makes sense, right? We don't go from new high to new high to new high to new high. Usually you hit a new high and then you have a little bit of a decline and you maybe sit there for a little while before advancing to another new high. And so the new high state is sort of the minority of the conditions that the stock market's in. Drawdown is more the norm. And then he found another interesting thing, which is large drawdowns or significant drawdowns are actually something like 75% of the 75% of time that the stock market is in drawdown. So so for example, if you think about this, meaningful drawdowns, say like a 20% decline, well, if you have a portfolio or the stock market that goes from X to 20% less, you have to make up all that ground, right? And if you have a very significant drawdown, like let's say the stock market during the great financial crisis, where the Dow and the S&P were down something like 65%, you have a significant ground to make up. And so it could be years before you make up and get back to your prior high watermark. Okay, so these two takeaways actually, it kind of brings home some conclusions that we can use as individual investors. And so first of all, you're gonna spend a lot of time below your prior high watermark as an investor. And there's a joke about this, right? Which guy is happier, the person that went from $0 to $1 million or the guy that went from $2 million to $1 million? They're both at the same place, both millionaires, right? But obviously, the one that went from 0 to 1 million is much, much more happy and experiences a lot less regret than the person that went from $2 million and lost half his capital, right? Even though objectively they have identical wealth. So part of the human condition is loss aversion, regret of things that you had before that you don't have anymore, basically just discomfort that you experience in a drawdown state or when you've experienced losses. And so this is where you can bring in some behavioral finance, some behavioral psychology, and know that when you're in drawdown, you're going to be in kind of negative emotional states and that's normal. I experienced them too. And also that a lot of your best and worst decisions will be made under the duress of a state of drawdown, perhaps under a state of a significant drawdown. So what you want to avoid at all costs is getting panicked out of the stock market during a sell-off, and then to experience the regret of not participating in the market recovery that would usually happen, because we have markets go through cycles all the time. They're up and down and all around, and you have corrections and you have recoveries. And a lot of this is just about patience and how not to get shaken out when things get sort of adverse, when you have kind of losses and you have to sit with them. So how do you handle yourself better during drawdowns, and how do you preserve your capital such that you have gains to benefit from when the rebound happens? Well, I solve for this with large cash balances. I carry more cash across market cycles regardless of the environment. I will tweak the cash up and down to some extent, but in general, I keep a significant cash balance so when a drawdown happens, I'm actually happy about it. I actually have an opportunity to put more money to work when the sell-off occurs. Of course, there's a trade-off, right? That means I have this cash is not working for me across a longer time period of the stock market, so I'm going to miss out on some opportunity cost at times, but the trade-off is I avoid or I lower the risk of poor emotional decision-making when the drawdown is going to happen. And inevitably, they're going to come when I'm not expecting it, and I want to be ready with the cash even though I'm not going to know when they're going to happen, okay? So again, this gets back to carry more cash, stay liquid, and then when the emotional discomfort happens, when the fear happens, when these normal negative emotions hit you during drawdown, you'll be able to handle them and manage them, okay? I'll put a link to the talk from Robert Frey in the notes below this video, and as always, thank you for watching.